Are you a first-time home buyer? If yes, here are 5 big money mistakes you should avoid. Understand the financing process from A to Z as you begin the journey of searching for your first home and learn the common money-related blunders that first-time buyers make. Watch the video to get tips on how to avoid these pitfalls and find out how to make an offer that is attractive both to the lender and the seller. Welcome back, folks, to another edition of Sweetie Kiwi. I'm very happy to have you today. I hope you are doing fantastic. If you're doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. Today I want to talk to you about 5 big money mistakes you should avoid if you're a first-time home buyer. Number 1, not knowing which type of home loan is right for you. We have a variety of home loans on the market, and depending upon your situation and your situation in life and your financial stability, you might choose one rate over the other. So we have the fixed rate loan. This is the most common type of conventional loan. It prescribes a single interest rate and monthly payment for the life of the loan, which is typically 15 or 30 years. One type of fixed rate mortgage is a jumbo loan. Now, when it comes, the fixed rate loan is right for homeowners who crave the predictability and aren't going anywhere soon, and they want to stay somewhere. They want to stay in the house for 15 or 20 years or 30 years, right? The rise and fall of interest rates in that kind of rate scheme won't change the terms of your home loan, so you'll always know what to expect with your monthly payment. And then we have the adjustable rate mortgage, also called ARM, ARM. An adjustable rate mortgage offers an interest rate that is lower than you would get with a fixed rate mortgage for a period of time. This could be 5 or 10 years, rather than the life of the loan. But after that, your interest rates and monthly payments will adjust typically once a year, roughly corresponding to current interest rates. So if interest rates shoot up, so do your monthly payments. If they plummet, you pay less on the mortgage. Now, this is kind of cool for home buyers with lower credit scores who are hoping that their credit scores will rise in the future, and because people with poor credit typically can't get good rates on fixed rate loans, so they would rather go with ARMs. And if this rate is also good for folks who are interested in moving out of the house after a few years, that's perfect. And then you have an FHA loan. Now, FHA stands for Federal Housing Administration. Now, while typical home loans require a down payment of 20% of the purchase price of the home, with an FHA loan, you can put down as little as 3.5%. That's because the government, through the Federal Housing Administration, is backing the loan, is subsidizing the loan. This is right for home buyers with meager savings who are, looking for an apartment or a house. The FHA has several requirements for mortgage loans. First, most loans are limited to about $450,000, and they don't provide much flexibility. An FHA loan is a fixed rate mortgage with either 15 or 30-year terms. Buyers of FHA approved loans, they're also required to pay mortgage insurance, that's a PMI, either upfront or over the life of the loan. And this PMI hovers around 1% or 1.5% of the cost of your loan. Next, you have a VA loan. Now, if you served proudly in the United States military, a Veterans Affairs or VA loan can be an excellent alternative to a conventional loan. But the thing is, you have to qualify, though, because it's not simply because you've served in the Army doesn't mean that you are automatically eligible for it. So if you qualify for a VA loan, you can score a wonderful sweet home with no down payment and no mortgage insurance requirements. And this is because, again, the U.S. government, through the Pentagon and the VA and the Veteran Administration, are subsidizing part of the cost. So a VA loan VA loans are right for veterans who've served 90 days consecutively during wartime, 180 days during peacetime, or 6 years in the reserves. Because the home loans are government backed, the Veterans Administration has strict requirements on the type of home buyers who can purchase with a VA loan. So it must be your primary residence. Don't think about using it as an investment property or secondary residence or vacation home. No, it must be your primary residence, and it must meet minimum property requirements. That is, no fixer-uppers allowed. Now, next we have something called a USDA loan. Now, another government-sponsored home loan is the USDA Rural Development Loan, which is designed for families in rural areas, right? So the government finances 100% of the home price for USDA eligible homes. In other words, no down payments necessary, and offers discounted mortgage interest rates. And a USDA stands for the United States Department of Agriculture. So the USDA loan is appropriate for borrowers in rural areas who are struggling financially. These home loans are designed to put home ownership within their grasp with affordable mortgage payments. Now, the only catch is, and there is a catch, right? I mean, there's no free lunch, as they say. The catch is that your debt load, if you were to qualify for a USDA loan, cannot exceed your income by more than 41%. And as with the FHA, you'll be required to purchase mortgage insurance. And last but not the least, a bridge loan. Now, this loan is also called a gap loan or a repeat financing. It is an excellent option if you are, let's say, you are just buying a home before selling your previous residence. So lenders will wrap your current and new mortgage payments into one. Once your home is sold, you pay off that mortgage and refinance. Right? A bridge loan is wonderful for a homeowner with excellent credit and a low debt to income ratio, somewhere around 20% or 30%. That's great. And if the homeowner does not need to finance more than 80% of the two homes combined value. So if you meet those requirements, this is a great way of transitioning between two houses without having a meltdown financially, physically, or emotionally in the process. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We are having a conversation around the 5 big money mistakes you should avoid if you're a first-time home buyer. I gave you the first big money mistake. Let's go to number 2. Number 2, not understanding your financing options. So you want to understand the pros and cons for each home financing option, whether it is a 30-year fixed rate mortgage, a 15-year fixed rate mortgage, or a 5-year adjustable rate mortgage, right? Now, your situation and how long you plan to stay in your new home will help you determine which financing option is right for you. If you remember earlier, I was talking about whether you want to stick around in the new home for 20, 30, 40 years, in which case you want to go with a fixed rate mortgage, or if you plan on moving out after 5 years and going elsewhere, then you want to go with an ARM. Now, what interest rate can the lender offer you? The best way to understand your financing option is to ask the lender which interest rate they can offer you. You also want to ask them if the rate comes with points, right? And whether or not this is a fixed rate or adjustable rate. Now, we've dedicated an entire show on how you can understand the financing option. So you might want to double check that. But you also want to know something very important. If you go with an ARM, with an adjustable rate mortgage, how is the adjusted rate calculated, and how often the rate adjusts after that, right? So you want to know the initial fixed rate period, if it's 5 years, and then how often does the rate adjust after that. Mistake number three, not knowing your credit score. Now, a lot of people are still going around. It is estimated that about 30% of adult Americans don't know their credit score. And I'm talking about people who are active economically, people who are working, who are paying insurance, they're paying rent, but they still ignore their credit score. And you want to find out. So a credit score can help mortgage lenders learn about your credit history and see what type of borrower you might be, which may determine your interest rate. So it is in your interest to know your credit score, actually to pull up a copy of your credit report and identify just check out if everything is correct on the report, right? Because there might be inconsistencies, there might be inaccuracies, and if there are, you want to fix those before even being on the market for a mortgage. If you don't know your credit score, you may want to consider getting a copy of your FICO score from each of the 3 major credit bureaus. I'm talking about TransUnion, Equifax, and Experian. you can receive a free copy. Remember, by law, you can receive a free copy of each credit report at annualcreditreport.com once every 12 months, and it's free. The good thing is, a lot of experts are suggesting that you check your credit score at least a quarter, 3 months before you begin house hunting. So if you find any errors, like I said, if you find errors or inconsistencies or it's things that don't look right, this gives you time to correct them. All right. I'll be right back right after this. By the way, if you enjoy the quality and clarity of the content so far, please consider subscribing to our channel. We provide this sort of shows every single day, rain or shine. And please turn on the notification bell so you are informed by YouTube or any other platform where you listen to us from as soon as we release the new show. And we do this, as I said, every single day. Like this content, comment below, and share your experience. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We're also having a conversation around the 5 big money mistakes you should avoid if you're a first-time home buyer. And right now, I'm going to number 4, failing to be pre-approved for a loan. Now, you have to understand, before even getting on the market for a new mortgage or house hunting, you want to run the numbers and determine your housing budget. And you want to talk to your mortgage lender about getting pre-approved. This will save you tons of time so that you can move quickly as soon as you find the house of your dreams. When you're ready to put an offer on your dream home, having a pre-approval letter actually may put you in a stronger position against other bidders who did not get pre-approved. Think about it, because if the house is really great, you're not the only person eyeing that property. There are other bidders. So if you want the seller to move quickly in your direction, you want to show them, hey, here is a letter of pre-approval. Everything is fine. The bank is behind me. They're just willing, they're ready to get things down. So you want to get that. And the good thing also with the pre-approved mortgage loan, if you will, mortgage letter, if you will, it allows you to know how much you can borrow. Because as you go through the pre-approval letter, as you go through the process, a mortgage lender will want to review your financials, right? Your income, your debt load, your employment history, to determine which amount they can lend you. So experts are saying that getting pre-approved for a loan before you start your search will help you act quickly when you find the right home. And experts are also saying that you want to keep your debt load to 30%, between 30 and 35, so 1/3. All right, even lower, it's way better. Number 5, money mistake number 5, overcommitting your spending power. Now, mortgage lenders generally will qualify a potential buyer for home loans based on their debt to income ratio. That's what I talk. It's the same thing as debt load. All right. Your debt to income ratio, your debt load could be more like the total amount you owe. But some specialists will either express the debt load in a percentage, in which case it becomes a debt to income ratio, or they will express it as an amount, as a number. So debt to income ratio is you just lump all the debts you have, credit cards, car loans, mortgages, into one category, and you take your income into the other category and you just divide. So you divide the debt to the income. So the ratio does not take into account any of your fixed expenses like utilities, insurance, or taxes. So you need to go through your budget to figure out how much disposable income, disposable cash you really have. So you want to account for things like property taxes and possible mortgage insurance and other related costs like home maintenance and a homeowner's insurance. I'm talking here about the kind of extra expenses you're going to have to incur once you get the house. So make sure you have enough savings to cover closing costs and the down payments. Now, down payments are typically 20% of, they represent 20% of the value of the house. But in some states, some lenders will accept less. But remember, if you pay less than 20%, this will result in a monthly fee called PMI, the private mortgage insurance, which is tacked onto the loan. Now, some first-time home buyers overcommit their spending power by borrowing the entire amount of the loan for which they are approved. And that's just devastating. That's just crazy, because By doing that, let's say you just saw a house that was priced at 400,000, and you basically borrow the full amount. And I'm talking, it's even more than 400,000, because you have the closing costs, you have origination fees and all the other fees. So the final amount might be 420, and you're borrowing the whole thing, which means that your monthly payment is huge, it's high, right? So this may lead to little flexibility in your monthly budget for fixed expenses, and also any unforeseen repairs or maintenance costs for your new home. So if you can avoid that, don't overcommit your spending power. So prior to meeting with the mortgage lender, you want to evaluate how much you can comfortably afford to borrow and still meet your fixed expenses. Build your savings account and adjust for potential changes like a job change or children or wedding or something happening in the family. You want to have some cash aside. We have several shows that relates to emergency funding, rainy day funding, and that kind of stuff. So if you go to our playlist around Watch Your Cash, you have all the series around savings, budgeting, and so on and so forth. All right, this is it, folks. Thank you so much for listening to today's conversation. I really appreciate it. Here was a recap of today's conversation. Here are 5 big money mistakes you should avoid if you are a first-time home buyer. Not knowing which type of home loan is right for you. Not understanding your financing options. Not knowing your credit score. Failing to be pre-approved for a loan. Overcommitting your spending power. I will see you next time, but until then, remember, stay marvelous.